I'm going to kick it off here. It looks like there's at least one or two more people joining from the waiting room, but I'm going to get us kicked off now. I want to be respectful of everyone's time today. As everyone already knows, I believe our institutional spotlight series is recorded. That recording will be available. So if you want to go back and watch some of the points that Michael makes today, you should all be receiving this in your email. It'll be put on the portal. So you'll have the ability to go on and watch this back again or see anything that you want to see after the meeting. So, let me get this started. Let's remind everyone again, thank you for joining the Advisor Network's Institutional Spotlight Series. The Advisor Network is really the only nationwide collaborative financial advisor and financial professional network, regardless of your affiliation type. RIA, broker dealer. If you work for a company that has a CRD, you're welcome to join our network. So we split our content into two areas. One is our peer-to-peer content sharing series. That's our advisor roundtable. And the other side of the equation is sharing with our institutional partners. Today, we're represented with Harris Oakmark. So before I get into those formal introductions, I'm just going to ask a few favors from everyone who's on the call today. If you could please do me a favor. And number one, keep your lines muted. That's really helpful when the speaker is presenting, so we'll be able to go through that. And then second, this is meant to be a very exchanging of ideas. So if you do have questions, it's meant to be a collaborative environment. Please put your questions in the chat. If you don't want to ask them sort of publicly, if you will, you can send me a private message that comes to only me. That gives me the opportunity to ask Michael the questions you have on your mind as we delve into this a little bit. So let me take a moment and I'll introduce Michael Mullane. First, I know he's on the call, but my relationship with Harris Oakmark goes with Carlos Virial. Carlos has been a wonderful partner of mine for a number of years at former firms and whatnot. I appreciate Carlos sharing with me as he's moved over to Harris Oakmark, some great things about the firm. And what you're going to hear today from Michael is a real focus on value. And speaking from personal experience as an advisor, it's an area where we have been under allocated for quite some time. We've made a conscious effort to think about that differently, and we're really excited to hear from Michael today on some reasons why you should be thinking about that as well. So Michael's a CFA. You'll hear in a minute. I think you'll know where he's from, but the UK, I'm almost positive. And Michael is a client portfolio manager with Harris Oakmark. And I've got a few questions at the end for you, Michael, teed up, but I really invite the rest of the audience here to chip in with your questions. So please share them in the chat. In just a moment, once Michael kicks things off, I'm going to sort of open the chat so that you know where to put that in. But Michael, without further ado, I'd like to kick it over to you, please.
Great. So thank you very much. I appreciate having a little bit of time to speak with you all today. So I'm Michael Mullane, Client Portfolio Manager here at Harris Oakmark. And I've actually been in the industry for over 30 years, focused on value investing for in excess of 20 years. So maybe give you a couple of minutes on who Harris Oakmark is and why we think value investing is finally having its moment. So Harris Oakmark, we've been around for now 50 years. Indeed, this year is our 50th anniversary. Value is all we do. Value investing is all we do. We manage just over $100 billion in assets, and we have portfolios that cover domestic and also international and global. The three things that we look for when we invest, it's quite simple. Companies trading at a discount to their intrinsic worth, companies that are growing shareholder value over time, and also companies where management think and act like owners. Now, if we think of the current market environment, for many years, many years, investors have been very heavily allocated to growth, either through a growth tilt in their portfolios, owning directly the Magnificent Seven, or indeed by just owning the S&P 500. Now, that clearly has worked extremely well. I think if we look at the last decade, the S&P has outperformed the 1,000 value index by around 4% annualized. It's what people are comfortable with. However, as we saw just this past quarter, and what a volatile quarter it was, there can be very extreme style reversals, and indeed value outperformed growth by 1,000% over, 1,000 basis points over just 3 months. Now that of course is only 3 months of returns. but we believe it's a good opportunity to think about allocating more or increasing your exposure to value. And also, we believe it makes a lot of sense to allocate to active management rather than passive. So today I'll run through a few slides, hopefully providing some market insight, and then speak to how we at Harris Oakmark are positioned in our large value equity fund, the Oakmark Fund. So maybe just a few minutes on where we see opportunity and where we see the market today. Firstly, I would just say that over the last couple of years in particular, we've seen momentum stocks significantly outperform the market, significantly outperform value stocks. Indeed, if you just look at the top chart here on this page, you'll see that in 2025 alone, the highest momentum companies returned 36%, very, very, very strong return, whilst the S&P 500 returned 18%. Still very strong, but nowhere near as strong as the top momentum stocks. Why is that relevant? We don't believe momentum as a style can outperform forever. There has to be a reversal to some point. At some point, companies that go to the stars, they have to reverse at some point. Valuations need to reassert themselves. If we just look to the S&P 500, and this in fact is somewhat related to momentum doing so well. I mentioned at the beginning that people have a lot of exposure to growth, but I think people sometimes don't quite realize that just by allocating to the S&P 500, what they're really doing is allocating to a growth fund. What we did here is that we put back the names that have been taken out of the information technology sector back into that sector. So names such as Alphabet, names such as Meta, MasterCard, Visa, we put those back in. And if you look at it from that perspective, as at the end of December, the information technology sector accounted for 45% of the S&P 500 index. I think also a relevant point to note, and I think everyone will be very well aware of this, is that concentration in the S&P 500 is at an all-time high. So we have around 5 companies that make up around 30% of the index. And I think also it's interesting, again, if we just look back to Q1, the Magnificent Seven, if we just rank them or look at them, they were down anywhere between 7 and 23%. And the underperformance of those names effectively drove at least 3/4 of the negative return that we saw in the S&P 500. So this concentration focus, the fact it's all more or less concentrated in tech, we see that certainly as a reason to think more about value as a style. Something else I think is really interesting is that because we've seen these giant cap companies just get bigger and bigger, the hyperscalers get even larger. The definition of a large cap stock has changed very dramatically. So if we were to look back 10 years ago, a large cap company was $17 billion to $78 billion. Today, a large cap stock starts at $81 billion. So a very, very significant increase. So looking at it the other way, according to Morningstar, a mid cap company is anything between $13 to $81 billion. Now, at Harris Oakmark, we invest in large companies. We don't necessarily invest in what would be classified as large cap by Morningstar, but this is really because we want to build truly diversified portfolios. And just looking at these very largest companies won't allow us to do that. So something else to note is that given the concentration that we see in the S&P, given the fact that the giant companies have just become even larger, we actually look to the 1000 value index today as being a much more diversified index. Indeed, at the end of December, 870 companies of the 1000 index were in the value index. And I think, as you see from this particular page, if you look across the sector exposures, they're much more evenly distributed. And in fact, if you were to look at the S&P 500 20 years ago, the sector weightings would be very, very similar, to what we see today in the 1000 value. As much as valuations have increased meaningfully broadly in the market, indeed, the PE ratio of the S&P 500 has gone from 17 times to 22 times. For us as value investors, as individual stock pickers, there's still actually a very robust opportunity set out there. And what this chart shows is that you've seen valuations rise quite meaningfully in the S&P. But if you take just that opportunity set of the 500 companies, the number of companies trading at 14 times earnings or less has remained very, very similar at around 150 names. I.e., yes, the market may be quite fully valued, but there's still great opportunities to buy really good companies at great prices. And I think, if I leave it here and then I'll speak to our own current positioning, what we're not saying is get out of the market, right? No one can time the market. And simply, if you look at this chart, if you had invested $10,000 in 1950, that would be worth $77 million today, irrespective of all the volatility, all the shocks that we've seen. Indeed, if we just look to the last year or so, so we had, the tariff issues back in March, April of last year. Obviously, we have had what I think we could call the AI Armageddon of the end of last year to the first 2 months of this year. And then, of course, we've had the invasion and the war with Iran. So things happen, a lot of volatility out there, but we certainly would suggest to be fully invested, but also very diversified when it comes to be fully invested. I'll just stop sharing my screen for a second, and I'm going to move on to speak a little bit to Harris Oakmark and where we're positioned today. So if I just reshare the screen. So, just a little bit as to where we're positioned today. And before I get there, just as a reminder, so the Oakmark Fund is our flagship US value fund. It's managed by Bill Nygren, Mike Nicholas, and Bobby Bierig. The fund has been around since the 90s. And you'll see just to the right-hand side that we'll own 50 to 60 companies. So it's a high conviction portfolio that really goes where we're finding the best opportunities which fit our criteria. If we look at our portfolio today, and I mentioned the extended valuations of the S&P 500, I mean, you'll see today that the S&P trades at 22 times earnings. It's the fourth line down here, 22 times earnings. Indeed, the 1000 value trades at 18 times earnings. Our portfolio today trades at just 13 times. I think also another line that we like to focus on is that you're not giving up growth for those cheaper valuations within our portfolio. And so the EPS growth of the market today is at around 15%. Ours is very similar at 14%. We offer a high free cash flow yield. And I think, part of our process is that improving shareholder returns. And many times, companies are able to increase their returns through returning cash to shareholders via buybacks. So we're big advocates of that, companies generating good free cash flows and buying back their shares. Now, if we look to where we're currently allocated, and this is very much driven from a bottom-up stock selection perspective. And whilst I did mention the fact that certainly the 1000 value is more diversified, over time we've been able to perform very well versus that index, and indeed versus the S&P 500. So where are we allocated today? So we have just over 30% in the financial sector. That weighting has actually come down quite a bit. We had higher weights just over a year ago. The sector had performed quite nicely for us. We're very diversified in that space. I think sometimes people think of financials as just bank stocks, but we own banking companies, consumer finance, financial services. We own exchanges. We own fintech companies, all sorts of companies that make up that exposure. So, we're highly weighted there, continue to be really quite excited. We've been finding increasingly opportunities in the healthcare space. It's an area that has significantly lagged the market over recent years. And what does that mean? It means that we're able to find more opportunities there. If we were to look back just 3-4 years ago, we were just over 2% weighted in healthcare. But given that underperformance and given the fact that the company quality in that space is really quite good, we've increased that exposure incrementally such that now it's our second largest weighting. Um, if maybe speaking briefly to energy, and obviously, the energy sector has performed extremely well, over the last couple of months. I think what's interesting here is that, we've had this higher exposure to the energy space for a good couple of years now. And it's not as if we were making a call on the oil price. Indeed, when we look to analyze and value our companies, we look for a mid-level price, somewhere around the low to mid $70 range for oil. I think if you were to look just a couple of months ago, oil was, in the 50s. I think people may have looked and said, "Whoa, that's a high price to allocate, to put in your models for the price of oil." Today we're over $100, and people are saying, "Shouldn't it be higher?" We look through the cycle with every company we're invested in, be it an energy stock such as this, or indeed a financial company that may be driven by interest rates. Now, that exposure to energy obviously has done very nicely for us, and as it has for the market, as it has for value. But certainly we still continue to find some undervaluation there. I think if you just look broadly across our exposures, we find opportunities in most sectors today. You'll see the very low exposure to technology. We have been higher in the past. When the opportunity is there, we certainly will take it. We've owned Alphabet for many, many years. More recently, we've been trimming back on that exposure because of the fact, it has performed so strongly. And certainly, given the fact that we've seen a lot of volatility in software in recent months, it's an area where potentially we could be finding opportunity going forward. So I'll leave it there. I spoke for quite a bit, and I'll see if anyone may have any questions.
We did get a couple already that came in, but I'm going to start when we prepped. I mentioned to you before, Michael, that I wanted to start with this question because as somebody who is allocating capital myself, you mentioned there's a very good rationale to why value. You mentioned also what you've built. Can you just give me a high level, just reiterate a bit, maybe, why we shouldn't just take the passive approach here, right? Why active management in this space, all things considered. And I don't consider you, to your point, mega cap, right? But in that sort of mid to large, but larger space, why active management right now versus just taking cheap passive plays?
Yeah, so I think that, certainly passive has done very well for many, many years. There's been a weight of money that's gone into it, but that also leads to the concentration which I spoke to. Where you have, in the S&P, 30% in five companies. It means that valuations can get skewed. And maybe the converse to that for people such as ourselves, we are managing a portfolio with just over 50 companies. And by thoroughly analyzing 50 companies, we certainly believe that you can outperform over time. And that's certainly what we've been able to do when we look over the relatively short term, the midterm, and the long term. I think the idea that active management is dead, that's become, obviously, very much in many people's mindsets. And I think for a while there, it certainly was true. And I think also somewhat of a challenge has been that you've seen markets just go up year in, year out. But when you see a little bit more volatility, and when you see names such as the Mag 7, which I mentioned, roll over, it's just a very good time to have that conversation about diversification. And I think as much as we can say why value, I think a bigger part of that is that portfolios just need to be more fully diversified.
Great answer. Um, I've got three questions from the group out there. What I'm gonna remind the group is, first thing I'll remind the group, because this happened to me the other day, is you can private message me, which you've been doing, so that thank you for the folks that have done that. The my I've always asked, don't text me, but I still get text every time. So it's going to continue to happen one way or the other. But I'm going to ask the questions as succinctly as possible. There was some, and if I didn't ask your question appropriately, send me a quick note and let's make sure that I can do that. The first one seems pretty easy in order for me to kind of ask it the right way. You mentioned PE as the measure of value, but other value managers sometimes look at dividends as maybe their biggest piece. There's some other pieces here, but let's focus on the dividend side. So, are you focused on dividends as well, or is really price the most indicative piece of whether that's a value or not?
Yeah, I think that's a really good question. So as much as I highlighted PE, we don't start there. We don't actually believe that investing in just statistically cheap companies makes sense. Rather, we're looking for companies that are trading at discounts to their intrinsic worth. And I think I mentioned I've been in the value space for decades now. Owning low price to book, low price to book, just low PE companies in the past worked very well. That's not really the case now. But certainly, just to frame the portfolio, it's something which we do. To answer the dividend question, and I kind of alluded to this a little bit earlier, our portfolio overall has a high free cash flow yield, higher than the market, higher than the value index. When our companies are looking to allocate their own capital, we're fine with them paying a dividend. But if we believe that the company itself is undervalued and they have no better use of that cash, we'd actually prefer them to buy back shares rather than pay a dividend. And in that way, shareholder value is increased. And I think, yes, certainly some of the value managers look to that dividend yield, and there are high yielding value managers out there. But we look at something called the total shareholder yield, which is dividend yield plus buyback yield.
So the next question is going to go somewhat in line with that, and you've answered a piece of it already, but I'll ask it directly how they asked it. How can a value manager have a 0% utilities allocation? Obviously, a traditional staple, I guess, if you will, in there.
Yeah, so this actually comes a little bit. So yes, we're not focused on dividends, which I think many value managers are. But it also comes from the fact that we are looking for management that think and act like owners, that have the ability to grow the value of the company over time. And generally, when we look to the utility space, and there's fixed margins, there's ultimately kind of fixed profitability. We don't find there's, frankly, a great opportunity for the intrinsic value mismatch to really be there, and we just find other opportunities in other spaces.
Two more that came in. Another one just came in a minute ago, and this one might be simple one to answer, but the way that you describe the S&P 500, and we view that usually as core, but you described it essentially as growth, right? And showed us evidence of that. So the question is, why do you benchmark against that if you know ultimately it's not the right fit?
So to us, ultimately, it's not 100% relevant to us which index we're benchmarked to. Now, for the Oakmark fund and for other strategies, we do look to both the S&P 500 and the 1,000 value. I would say that we have an eye on both indices. It doesn't drive where we're finding opportunity, doesn't drive how we're building our portfolio. But certainly we also believe that ultimately clients want us to generate a good return over the long term. So that's why we look to both. Certainly the skew of the S&P 500 has been hard as a value manager to outperform, but nonetheless, we'll look to both of those.
I think, I'll just add in here, and you can correct me if I'm wrong, but firms like Morningstar kind of put you in that bucket anyways. So unfortunately, whether you choose it or not, they're going to benchmark you to
Yeah.
that.
Yeah, and I mean the reality is that we are value through and through, and I think just speaking to Morningstar a little bit that they give a value growth score to every company, and they changed the methodology a couple of years ago because the S&P for a very short period there very much became a growth fund.
And so it's interesting. You led into the last asked question. So if anyone has another question, well, we're kind of going through this. I'm happy to take it. Otherwise, I'm going to ask this one, and we'll kind of see where we stand. This has been an excellent discussion so far. Uh, there is a brand new word. I had to actually write it down because I was a little concerned I was going to get it wrong because they say it better than I can. Has the S&P growthification, which I'm not sure that's a word, but that's fantastic, happened just recently, or has it happened slowly over time? And I think the references you mentioned, if you looked back, I think you said maybe 20 years ago that these numbers looked more similar, and now obviously it's changed. So growthification, has it happened more slowly, or is it just kind of the pop we've seen in IT?
Yeah, so I think, that if we look historically, there's always been cycles, where growth outperforms for a period of time, value outperforms for a period of time. Ultimately, we would believe that value should do better over time because there should be some sort of, grounding, some valuation mechanism over the long term. The markets will move to intrinsic worth. I would say that if we consider post the global financial crisis, really prior to that, you saw that handoff between growth and value. But post financial crisis, I think particularly here in the US, there was a major shift towards intangible assets and returns on intangible assets, a shift towards technology, and the fact that that hard assets weren't really being rewarded. Capital intensive companies weren't really being rewarded. So in that way, I think, that the S&P did become more growthy, but then it really took off, over the last several years where you saw that concentration increase, you saw the Mag 7 perform so incredibly well, and therefore just the overall index become very growthy. Whereas before it was exhibiting the growth characteristics that we saw overall in the market.
And I'm going to end with one I used to do in most of our live panels and things like that. And Mike, we didn't talk about it the other day, but I feel like you'll have this one ready. Um, if you were to pick one thing that sort of keeps you up at night, um, we have it's a very interesting part of the world to ask that question, right? And I'm going to limit you to one because it could be could spend the next 30 minutes on this topic. What's the thing that keeps you up at night thinking about the global macro markets, value, client portfolios? I'm going to let you pick where you want to go with this.
I would say that it is most likely, as much as I pointed to the fact that you should remain fully invested, and doing so, clearly you've made an enormous amount of money over time, just given the market valuations today. And given the fact that in many ways, at least the S&P was almost priced to perfection, and in fact, if you look at the 22 times earnings of the S&P today, and if you look historically what the subsequent 5-year returns have been, they've been fairly muted. So I think that there's a risk that people expect the S&P just to go up 20% a year forever, and that's most likely not going to be the case. And I think people just have to be aware that there will be more volatility and embrace that.
I think that's a great answer. I will, I'll echo that as someone who's looked at our own personal portfolios as an advisor, we are making an active shift to sort of fight the growthification. I'd use it one more time. I think no one thought I could say it, so it was kind of probably a little bit of a joke on me, but I got it out. We're trying to challenge that and obviously build portfolios that are ready for the future here, not necessarily what's done well the last few years. So I think what you presented today is a really good view on value. And a good opportunity for everyone to think about that more. What I'll offer everyone who's on the call, as well as when this is distributed to you, if you're watching this after it's been sent out, if you want to hear more from Michael and the team at Harris Oakmark, if you're looking for the slides that came with this, I'm going to introduce you when we send out the information to Carlos. Carlos is a great point of contact, somebody that can follow up and get you those materials. We'll make whatever we can available to you. But I sort of ask everybody to follow along with Harris Oakmark, get the education on value, and look at your client portfolios and see if that's a great fit, depending on what your exposure is, obviously, across the way. Adding a couple of quick notes before we say goodbye to Michael. If you were on the call yesterday, you heard this, but we have our local regional events coming up in Miami, followed by Saratoga Springs, New York, and then Los Angeles. So those are opportunities in groups of 20 to 30 advisors to come together in 3 different areas. If you are local to one of those areas, or if you just want to go to one of those areas, we welcome you. Our national event will be in November at the Park MGM. We'll have a wonderful agenda and a great opportunity to collaborate and speak. So we welcome you, as well as additional virtual content throughout the year. More and more info to come as we get larger. We can't thank all of you as advisors and members of the advisory teams for joining us and growing at the rate we're growing, but we can't do it without partners like Harris Oakmark. Michael, thank you so much for doing that. Carlos, thank you for being a supporter. We appreciate you guys, and hopefully have a great rest of your day.
Excellent. Thanks very much.
Be well, everyone.